How many stocks should I own in my portfolio? What is up everyone, it's David here. Now in this video, I'm gonna answer that exact question, and along the way, I'll be revealing how I constructed my dividend growth investing portfolio step by step. Now make sure you watch this video all the way to the end because I would love to hear from you in terms of what I could have done better constructing my own portfolio. Now I don't want to nag you all the time to gently smash that like button, but it really does help out the channel out a lot. So if you wouldn't mind, if at any point in this video that you learn something brand new, make sure you gently smash that like button because that will mean a lot to me. Now without further ado, let's go! Now when it comes to answering the question, how many stocks should I own in my portfolio? There's mainly two schools of thoughts. Now you have the Buffett school of thought where diversification really is just a protection against ignorance, and I'll play the clip for you right now.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
And Warren Buffett's thesis is actually quite evident in his Berkshire portfolio because majority of his holdings is in a handful of companies. Now you also have another school of thought where fund managers hold upwards of 100 companies to diversify away some of the specific risk that comes with investing in very specific companies. Now for me personally, I'm probably in between the two school of thoughts. I like to tackle the question in two steps. The first step is, how many sectors do you personally want to be part of that will endure the test of time? The second step is, if you are an owner of a business in that sector, which would you personally want to own over the next 20 to 30 years? Let's go through these two steps with my own example, and along the way, I'll explain to you why I've chosen certain companies to invest in my dividend growth portfolio. Now, the first step is, how many sectors do I want to be part of that will endure the test of time? Now remember, I'm a long-term dividend growth investor, so that will really influence how I choose these sectors. So the first thing I always like to do is I just want to eliminate the sectors I don't really want to be part of, and that's defense, industrial, utility, and also energy. To be honest, most of these sectors I just don't really understand it, and I'm just not really interested, so I'm gonna get rid of those sectors first. And that leaves me a couple choices in terms of the sectors I do want to be part of, and the sectors I do want to be part of is consumer, financial services, tech, real estate, and also healthcare. Now, the way I like to think about the sector that I chose is that they all have an essential element to them. It means that no matter the times are good or bad in the future, we're always going to need them. And I believe they're here to stay for the next 30 to 40 years. Now, once you've chosen the sectors you want to be part of, the next step is, if you are a business owner within that sector, which business would you want to own for the next 20 to 30 years? Now, for simplicity's sake, let's focus on the consumer sector. Remember, I'm a long-term dividend growth investor, so dividend growth is a very essential element to me. And because of that, I went to the most updated list of Dividend Aristocrats to start my shortlist of stocks. Now, Dividend Aristocrats are essentially just companies who've increased their dividends for 25 years or more. Now, once I've gone through the Dividend Aristocrats, the next step that I did is I went through the S&P 500 to see if there's any other companies that I will include in my shortlist of stocks for the consumer sector. And it all came down to 5 stocks. You have Coca-Cola, Pepsi, Walmart, Costco, and also Home Depot. Fun fact, did you know that PepsiCo is not just a beverage company? They also owned Doritos, Grain Waves, Cheetos, and even at one point, KFC. That's why you can never get Coca-Cola in KFC. And Cheetos, Grain Waves, and Doritos are all my favorite snacks. So that's already bonus points for Pepsi and Co. And one more thing, if you haven't been to Costco, you really need to. Because every time I go, it's like an adult theme park. Shin Ramen's crazy cheap, so are eggs, everyday stuff, even underwear. But honestly, if you have access to Costco within your city, you should definitely pay it a visit. It's an incredible experience. Now, back on track. You can own all 5 if you really want to, but let's dig into the numbers to see how each of the 5 companies that I shortlisted are doing. Now, from a quantitative standpoint, earnings growth is one of the first things that I look at because at the end of the day, dividends are paid out of earnings. Now, if your earnings aren't growing, it's hard to sustain that dividend growth over the long term. Then after that, the next thing I look at is dividend growth over a long time horizon, especially how they dealt with recession events, whether they cut the dividend or weather through that storm and continue to pay out dividends. Because if they can pay out dividends in recessions, it's a really good sign that their management team is able to navigate really turbulent environments. Now, when it comes to Pepsi, you can see that there's an upward trend to dividends growth. And even during the tech bubble 07-08 crisis, they're being very, very stable and they've never really cut the dividend and they've actually increased it over time. You can actually see that it's a very similar story to Home Depot and also Costco too. Home Depot started paying their dividends around 95 or 96, and even during a tough time they have kept their dividend at the same level. They haven't decreased it. Again, a really, really good sign that they are able to navigate these really uncertain times. Now, the thing is, all three of them look really good from a dividend growth standpoint. And at the same time, if you look closely into the numbers, between those three, Costco have the most room to maneuver, since their payout ratio is still relatively low and the dividend growth is high and also their earnings growth is high. But unfortunately for Costco, the starting dividend yield of 0.91% for me is just a little too low. And in the future, I might pick up some just because I really want to own the company and I really does love shopping in Costco. But for now, I'm just going to prioritize my capital for the other two companies, and that's Home Depot and also Pepsi. And that's exactly what I have in my stake dividend portfolio, which is what you see on the screen right now. So after going through those two steps, that leaves me with two companies within that sector. And what you want to do is you want to rinse and repeat for the next couple of sectors you want to be part of. And ultimately, you have your answer to how many stocks should I own in my portfolio. Now, for the length of the video's sake, I have purposely left out economic moats and also financial health of the company, even though I've done that research already for these companies. I'll save those topics for a future episode because if I include this in this episode, it's gonna take ages to finish. Now, in terms of sector allocation, I have equal capital allocation for all 5 of my sectors. And percentage within sector just means that what percentage of my capital within that sector is allocated to that stock. So for real estate, I have 2 REITs. The first REIT that I have is Realty Income Corp, which is a diversified commercial REIT that pays a monthly dividend. Now, some of the biggest tenants are Walgreens, CVS, Dollar General, and even some cinemas and also fitness centers. Of course, during these times, the fitness centers and also cinemas will be affected. But thankfully, Realty Income Corp's biggest tenants are actually in the convenience store space, pharmacies, and also grocery stores. So even though their income is slightly affected, it's not as largely impacted as some of the other REITs. Now, the second REIT that I have within real estate is Prologis, and Prologis is a logistics REIT. So some of their biggest customers are e-commerce stores, like for example, Amazon. Now, for financial services, I have 3 companies. I have JP Morgan, Bank of America, and also T. Rowe Price. The most interesting one out of those 3 is T. Rowe Price. Now, T. Rowe Price is a dividend aristocrat, which means that they have increased their dividends for 25 years consecutively. And during the financial crisis, they actually increased their dividends. So their track record speaks for itself. That's why I have a heavier weighting for T. Rowe Price. And hopefully in the coming weeks, I'll probably increase my position in them as well. Now, for the other 2 banks, I'm just accumulating stocks at the moment because it's more affordable to get them now than to try and get them later. Now, for consumer, we already talked about it. And for healthcare, I have just one company, and that's Johnson & Johnson. Of course, there's plenty of other choices like Pfizer and some of the other bigger pharma companies. But to be honest, with some of the other pharma companies is a little bit more technical. I need more time to understand them. But for Johnson & Johnson, I understand it the best. I've been using their products since I was a baby. So for healthcare, I just have Johnson & Johnson. Now, for tech, if you haven't watched my previous video in terms of why I chose dividend growth investing, Dividend Aristocrats is supposed to outperform the broader stock market in these times of uncertainty. But that is not always the case because in our health crisis right now, the help that we really need is from remote work access and also e-commerce. And Dividend Aristocrats just are extremely underweighted in these areas. So to round out my dividend growth portfolio, I want a little bit of tech exposure. And for me, Microsoft is a great pick because majority of their money is made from enterprise deals. And for companies to switch from Microsoft to, say, for example, Slack, it's just incredibly difficult. And we can see that since the crisis happened, their earnings have gone way, way up. Apple is a bit of a no-brainer as well, because I think now that people are spending a lot more time at home, they'll be spending a little bit more time to think about what gadgets or what computer components they need at home to be more productive. So I just want to at least dedicate 20% of my portfolio to tech to fully round out my dividend growth investing portfolio. Now, what you see in front of you is a screenshot of my stake portfolio. I purchased these shares just a couple days before I made this video because I didn't want you to think David just talking about these stocks. No, I am truly invested in them. I believe in them, and I think I'm going to be holding them for the next 20 to 30 years. Unless their economic mode is, for whatever reason, suddenly disappeared, then I might change my mind. For now, I believe I'm going to be holding them for the long term. Now, with my Australian portfolio, not much has changed, to be honest, since the last time you've seen it. This month, I'm still going to add to my position, but I'm going to hold on to a little bit more cash because I'd love to see what's going to happen once we open up the economy a little bit more, and then I'll decide where and how I'm going to deploy my capital. But right now, I just want to put a little bit more cash in my emergency funds, just in case if something happens. Now, to keep myself accountable and also motivated to keep investing, I've created charts where I can see my progress when it comes to my expected monthly dividend. Now, my expected monthly dividend is just however much I have in my portfolio, multiplied by the dividend yield of that stock currently. Now, the red line is the actual amount of dividends I got paid for that month. Don't be shocked by the spike in March 2020. It's just with some stocks, they only do dividend payments twice a year. So instead of a small amount, they do a big amount for that half of the year. So yeah, I just wanted to at least let you know that. The dividends that I get paid are immediately reinvested. For now, I think because I still have a long investing time horizon, I think it's better to reinvest the dividends now. Unless I really need the money, then I might change that reinvestment to just receive it as cash, and then I'll decide what to do with it. And I thought I'll share my investment thesis as well. This is a very rough draft, but my objective as a dividend growth investor is to continuously seek and invest in companies long-term with resilient moats and dividend growth track records to grow my passive income stream. I just want to at least put my investment thesis out there. As I mold it, as I shape my investment thesis in the future, you'll see where I'm molding or changing it from. And in some of my future videos, I'm probably going to keep referring back to this. Now, with some market news, Airbnb have basically made 25% of their workforce redundant. This is actually a great letter coming from Brian Chesky, and it's probably one of the better letters I've read about having to let people go and how difficult it is. I'll leave a link in the description below because I think that this is such a class act from a great co-founder, arguably one of the better ones in our generation. So, and trust me, if you can get into Airbnb as a designer or engineer, there's plenty of other tech companies that's hiring as people are firing. So it's very likely that that 25% workforce will probably get hired immediately as they leave. And the same thing happened to Uber, and I believe that for the Uber employees as well, they're highly employable, which means that as they leave, a lot of other tech companies will pick them up along the way. I just believe this is not a bad thing after all, because redistributing some of this talent across the economy is going to help recovery happen faster. So I think it's really important during this period to, one, take care of your body. That means eat healthily and also try and exercise as much as you can, because I find that exercise really helps with my sanity as well, so that I don't live in my head for too long and I get all anxious. The second thing is you want to cut your expenses as much as you possibly can. And the third thing is make sure you take the time to learn something brand new that you personally enjoy, or something that will future-proof yourself. And if you can, try and use what you've learned to build a side hustle for yourself. Now, for me personally, creating videos is a brand new skill that I've learned over the last 3 months or so. I am a technical marketer, so when it comes to creating content, I am just incredibly useless. So if you've seen some of my early videos, you could tell that the lighting is definitely no good. My script is awful, but over time I've gotten better at it. And some of the videos that's on my blog right now is starting to generate momentum, it's starting to generate a little bit of advertising revenue. So I'm really thankful for that, and I'm really thankful for your feedback as well, and that means a lot to me. That's it for this week. So if you enjoyed this video, make sure you gently destroy that like button, because that will seriously help out my channel. And also remember to subscribe, click onto the bell, so that next week when I release an update on my portfolio, you'll be the first one to know. And he will do the honors as usual. See you next time.